If your company in Ireland has built up more R&D tax credit than you can use against your corporation tax bill, there's an option that a lot of companies don't realise exists. You can surrender part of that excess credit directly to key employees on your research team, letting them use it against their own income tax. It doesn't cost the company anything extra, and it can be a useful way to reward technical talent when cash is tight, but you need to hold on to your best people. Here's how it works. Once you've claimed your R&D tax credit worth up to 35% of qualifying expenditure and used what you can against your corporation tax liability, any excess doesn't have to be claimed as a cash credit. Instead, you can surrender some or all of it to qualifying employees, who then use it to reduce their own personal income tax. The company still gets the full value of the credit, it's just being shared differently. Not every employee qualifies though. Revenue sets out 3 criteria, and all 3 have to be met. First, the employee needs to spend at least 50% of their time on qualifying R&D. Second, they can't be or ever have been a director of the company or any associated company, and they can't be connected to a director. And third, they can't hold or have held more than 5% of the company's shares, and again, can't be connected to someone who does. In practice, this usually describes senior researchers, principal scientists, or lead engineers who are doing the hands-on R&D work without being an owner or director. The transfer itself happens in 3 steps. The company makes a Form CT1 election, designating the credit as a corporation tax overpayment. It then specifies how much of that is being allocated to each key employee. And finally, it issues written notification to each employee, stating the amount surrendered and the date. There's no prescribed format for this, but it needs to go out promptly after the CT1 is filed. Employees will then claim their credit in the tax year following the end of the company's accounting period. So, if your accounting period ends 31st of December 2025, you filed the CT1 in 2026, and the employee could claim in the 2026 tax year at the earliest. Employees keep their eligibility even if they've since moved on from being a key employee, as long as they qualify during the period the credit relates to. There's also a cap on how the credit can be used. It can only be set against income tax on paid from the employer that surrendered it, not against any other income. And if an employee's effective income tax rate, including any spouse or civil partner income, is already 23% or below, they can't use the credit at all. If their rate is above 23%, the credit can only bring it down to that 23% floor, with anything left over carried forward to future years. Used well, and this is a straightforward way to pass real financial value to the people actually doing your R&D, without it costing the business anything beyond what it's already entitled to claim.